What's up, everybody? It's your boy, Brandon, back with another edition of the Macro Insights podcast. But first, before we get started, a little disclaimer. I am not a financial advisor, and the guest is not giving financial advice. So everything you hear on this podcast is strictly opinion and should not be taken as financial advice. We disclose if we have any holdings discussed in this podcast, and you should not be following us as financial advisors. You should discuss this with professionals before you get involved or invested. And as always, it's not financial advice. So please, please, please take this strictly as our opinions and for entertainment purposes only. Now let's get into the show. What is up, ladies and gents? I'm back with another edition of the Macro Insights podcast, but I'm doing a very special solo rip. I was just in New York and Montauk for a wedding this past week. So dealing with scheduling issues and other things like that, I think it was just easier to kind of come to you guys a little bit solo this week and give you a little bit of my thoughts as to what is going on currently in the market and the overall macro environment. I know that I get a lot of people bringing up their opinions and talking, left and right about what they believe is going on my Tuesday night spaces at 8 p.m. But I don't think that, people really get to hear a lot of what I, say and believe. Of course, I'm not a macro, I would say, expert or anything like that, but I do get a lot of people that come in and bring their opinions as to what is going on in the market. And because of that, I get kind of a good, just general understanding as to what is going on. But, I know a lot of people don't necessarily know, the ins and outs of everything like that. So I'm kind of bringing this, and I want it to be a little bit more of, I guess, maybe beginner talk, or maybe a little bit on the lower end side, just to kind of bring as to what I've learned over this little bit of time I've been doing this podcast and other things, as well as kind of take a dive into what I see it going and how the Federal Reserve is reacting to everything and how that could potentially affect markets and all this and that. So I'll start off. I've made like kind of a list of questions that I want to go through and discuss. And the first one is, what is inflation and why is it bad? So, everybody's kind of talking about inflation these days. And, I know people understand inflation, but I don't think that they really understand, I guess, the ins and outs of everything. It's reported as a metric of CPI, or Consumer Price Index, which is essentially looking at a basket of goods and seeing how much it's increased over a year-to-year period or month-to-month, that kind of thing. And so what inflation is just strictly looking at whether it's down to a specific good or service, or the overall level of how much prices have increased over the past year, over the past month to month. You can look at it at various different, I guess, time periods. But the reason that inflation is bad is, it is kind of expected. The Fed generally has a target of about 2% per year to kind of increase. But that also kind of makes it also, give a little pressure that productivity needs to increase by 2% every year. So, and that's not always the case. Generally speaking, people like to look at, products and services and say, I bought a Big Mac, for example, a year ago at $2, and now it's, $4 or $8 or however much it's gone up. And you're not getting any different of a Big Mac. You're getting the same exact Big Mac. You're getting same exact ingredients, same exact, output and things like that. Only thing that might have changed is that your dollar is now have less spending power, or your whatever currency you use. And so right now, the United States dollar is the global reserve currency. And because of that, anytime the dollar loses purchasing power or loses, value, what you can exchange for goods and services, whatever you buy and sell in any kind of market with any other currency also decreases as well. And so the goal is to try to multiply or gain, earn more money than then the amount of purchasing power is going down. So it's bad because generally speaking, the rich have a lot of assets, which, the S&P 500 increases by an average of 8%, 8 to 11%, depending on who you ask, each year. So if you imagine the overall goal is 2% of inflation, well, if you just simply invested in the S&P 500, that's a 4 times greater increase per year of your purchasing power of that, you know, of that specific thing. Now, obviously, rich people have, or the wealthy have, various assets, whether it's real estate or, something along those lines. And, maybe a business, maybe they entered into a startup business that has the stock value in that company has multiplied significantly more than the S&P 500. A lot of other things, they have the more capability to kind of take more risk, where generally speaking, the middle class and the poor don't really have any of these investable assets. So they're strictly relying on their job to, get that pay increase. And if that pay increase is 3%, maybe their purchasing power goes up by, if they're lucky, by 1% each year. But, inflation affects different areas. And, like we said, the CPI does not always reflect how much inflation is, because it is a basket of goods. So if you look at, the most recent CPI print, it was 8.2%. So that means in order for, everything to keep up, you need at least an 8.2% increase in your pay from year to year. But granted, in these past months, we've seen an 8.5 CPI print. And so like these increases have become almost exponential. And we're seeing a dollar getting increasingly stronger compared to other fiat currencies throughout the world. And, the access to that capital is getting a little bit more difficult as well. But, at the end of the day, like it's difficult because a lot of these, people that are out here living and trying to go through each and every day to, earn more money, save. They just simply cannot keep up with inflation. And so that it's becoming more increasingly difficult. Purchasing power is decreasing. Rent is increasing by drastically more. And so they don't have any of these assets to kind of benefit from some of this inflation. And so that is drastically increasing the wealth gap. And so, how is the Federal Reserve attempting to address inflation? Well, the lever that they're pulling right now is that raising interest rates. So what raising rates means is essentially at the rate you get money from, banks and other things like that. But the way that banks get money is, that these interest rates are determined by the Federal Reserve, and then the Federal Reserve loans out that money. So if the Federal Reserve has low interest rates, then banks give out money at a very low interest rate as well. So that makes businesses the ability to get a business loan a lot cheaper. People are generally making more money, so they're at the end of the day, have the availability to go kind of borrow some money, borrow against that, hedge against some of their assets, et cetera, et cetera. And so the Federal Reserve, by raising interest rates, makes the access to capital a little bit more difficult, which is kind of deflating some of those asset prices. But the problem is that if you have a house, say for example, you bought it at 500,000. I'm just making it, or maybe 100,000, right, to make the numbers easier. So you bought a house at 100,000. That house went up by 50% in the past couple of years because we've seen some of these areas just drastically increase, right? So now you have a $150,000 house. Well, you've done nothing really to that house, and it's increased by 50%. And now the Federal Reserve is raising interest rates. Well, it's dropped from 150 to 140,000, but that interest rate went from 2.5%, 3% to 7%. Even with that drop, or at the same price, even if that house fell below the original purchase price, say it dropped all the way from 150 to 90,000. See, so you got a house that's the same house, but 10,000 more borrowed. That payment every single month is still going to be drastically more than the original one with at 100,000 with 3%, 3% interest rate when it's a 7% interest rate. Because if you look at your mortgage, if you're lucky enough to be a homeowner, majority of that payment is, interest, insurance, and some of these other things, while very little goes to the principal. You're paying off the principal in the United States over a 30-year period. And so by raising these interest rates, they're kind of, decreasing the amount of money that's the ability to, I guess making it more difficult to borrow money. And so that is making it a little tough on the American economy. People are losing jobs, and that's kind of their overall goal, is like a lot of people are working, maybe two jobs or something like that. And so people are getting laid off and not having as many jobs to kind of go home to. They're making it a little bit more difficult to get a job, a little bit more difficult to get a higher paying job, as people were kind of just jumping left and right from job to job in this past market. And would leave one job and still go to another one and get a 15% raise, whereas they would stay at the same one and get, a very small raise. And so there was being more advantageous to kind of jump from company to company. Well, the Federal Reserve's kind of making that a little bit more difficult. And so some of the negatives are, it's more difficult to borrow money, more difficult to start a business, more difficult in the job market. People are obviously losing a lot of their jobs and everything like that. And the job market isn't quite as strong as people like to make it out for. And in turn, it is at the end of the day, is the question that I always come across is this strictly monetary inflation? And I think, to be honest, the answer is no. Is there other cogs to be pulled? I'm not really sure. That's not really where I've kind of, I guess, learned too much in just yet. I'm still kind of diving into the whole monetary policy aspect of it. But I think shutting down the global economy for, months, years at a time definitely made it where it is very difficult for these companies to come back to if you want to call it pre-pandemic, pre-COVID levels of productivity and production. And so because it's not necessarily a monetary issue, it's a lot of the supply side. By raising interest rates, they're making it more difficult. Now, the Federal Reserve is essentially trying to shock the system, raising rates at a rate that has never, ever been seen before. And because they're doing that, obviously there's going to be a big drop off, and then they're going to pull back. Now, there's been theories as if they crash the global economy, will they pull back and kind of let the foot off the gas a little bit? And I'm not really sure of that answer, to be honest with you. And I don't think that they will. I think that at the end of the day, they are making it that the dollar is the strongest of all fiat currencies, because right now it's the global reserve currency, having it access to that dollar, making it more difficult. Whereas like other countries aren't doing that. It is making it so that the United States dollar is absolutely crushing all other currencies. We've seen the euro fall below $1 for the first time in a very long time. We're seeing a lot of things like that kind of occur. And I think, on that note, I mean, the United States is better off than a lot of these other European countries and a lot of these other countries. But is that necessarily good for the global economy, because the global economy is so connected at this point? I don't really believe so. But, if you're an American stan and you're kind of, looking for the Americas or the United States of America to kind of pull on and produce a lot more, I think like you got to be happy with what they're doing at this point. Granted, it is making asset prices decrease a little bit, but we're having weird rallies in the market. Housing is going to be tough right now. And I mean, I think at the end of the day, a lot of these people are still kind of figuring out what they all want to do with the Federal Reserve and how you're going to attack the market. Now, I believe that these next couple years are going to be pretty tough. I wouldn't be surprised if we see a more of a, I guess, flatlined market over the next couple years. We see everything kind of going sideways because we saw a drastic run up and a drastic run down pre and post COVID. And during COVID, for that matter, I guess we're in the post COVID period right now. But I think like at this point we're going to see more of a market that is kind of going to go sideways. Now, will the Federal Reserve print more money, go through QE to maybe combat some of that? I don't really know. I don't know. The thing that I think is going to be interesting is that we're going through a lot of these election cycles. So right now we're kind of going through the 2 year, the midterm election cycle in the United States. And in another 2 years, we'll see, because politicians do whatever they can, kind of short-sighted, in order to maintain power and get votes. And so, will they do that and kind of maybe do some policies like money printing that will artificially inflate asset prices and make everything a little bit easier on everybody in the short term in order to get votes? I don't really know. I mean, I think I wouldn't really put it past politicians at this point. And I think that, at the end of the day, politicians are very, I guess, money hungry and trying to figure out what they could possibly, what they could possibly do to gain power and keep those votes and keep the voters happy. And so, I think that there's a lot of things still going on, a lot of question marks for it, and it leaves a lot of question marks for investors long term. Now, like I said, I see it playing out, kind of going sideways for a while. I guess the bearish and kind of cynical person in me thinks that we're on the brink of a potential big downward depression, and that's globally. But I think the United States is kind of is positioned itself in a way where it would feel the effects lesser than maybe some of these other countries. Now, what does that mean for investments in the United States? I don't really know, because there is the global aspect of the market where I think that maybe sales might decrease and some of these other things. Granted, I think that some sectors are going to be positively affected and some of them are going to be very negatively affected, as is what the case in many recessions. So I'll be looking for a lot of energy stocks, whether oil and gas. I think a lot of the policies that have been put in place previously have kind of made those commodities very advantageous. Now, the average person can't just go invest and buy a barrel of oil and just hold on to it and sell it later. But, you can also invest in companies that, do that and kind of run around oil. So I'm very bullish on that going forward, because obviously we've seen what's happened in Europe and in Germany specifically, where they became extremely reliant on Russian oil. And now the sanctions on, with Russia and the Ukrainian war have occurred. And, Russia's kind of, I guess, pulling the strings when it comes to Germany and a lot of Europe when it comes to oil production and other things like that. So I think there's a lot of question marks kind of going forward, which makes for an interesting discussion. But I think the United States is positioned better than most other countries. Granted, they should have probably started raising interest rates a while ago after they started printing all this money. But, you can always go back and play Monday morning quarterback. Will they be doing this continually to kind of, make sure that that dollar keeps ripping? I think so. And I think that that's at the end of the day, the Federal Reserve is going to be for America at all points in time. So I think that they're doing what's best for America, but not necessarily for the global economy. And I think that going forward, the continued effort of raising interest rates is going to be something that I'll be on the lookout for. I don't really necessarily see a pullback anytime soon. I think, I guess soon is relative, but I think through the rest of the year, obviously not. And I think through 2023, we won't really see any pullback. I think that they'll start to pull back when it comes to potentially close to that election cycle. The next election for the president of the United States. I think that, President Biden and the Democratic Party will probably put a little pressure on Powell, and that'll cause him to maybe make some more decisions. But, that's all speculation at this point. I think that, energy is going to be a big, big, big discussion in the next couple of years. And I think a lot of these growth companies that have benefited from a lot of, a lot of easy access to capital are going to be hurting in these next couple of years. So obviously not investment advice. I'm not a financial advisor, but the way I'm going to be positioning myself is, going into maybe some of these inflation hedges. I personally like Bitcoin and other things. And, I obviously have that other podcast and put out some content around there. But, some of these precious metals, maybe that's something that interests you, something that we can go in there as well. And then, some of these other commodities I'm going to be looking into. I think that nuclear is the way of the future, but, I think we're still a long way away from that actually occurring. So, maybe that's something I start to look into a little bit more. And then obviously in the short term, some of these like oil stocks, I think are going to be doing pretty well. So, I've been talking to myself here for a little over 20 minutes. So, I hope you guys enjoyed this one. A little bit of an opinion, kind of what my overall thoughts are on the market. And if you have any questions, feel free to reach out. Maybe I can kind of do a little bit more of these mini episodes where I kind of talk and just let some of my thoughts out, not have a guest. Let me know what you guys think. And if you guys like it, obviously, tweet at me at GreenCandleIT. Leave comments in the YouTube. Just let me know what you think. Overall, solo rip. I really enjoyed it. I've been running around, so thanks for bearing with me and putting this out a little bit later than normal. But as always, like, subscribe, share, follow me at GreenCandleIT on Twitter. And subscribe to everything, and hope to talk to you guys again soon. I'm out.